rebalancing really comes down to making sure that you're staying within the constraints of what you're comfortable with from a risk standpoint, right? When we sit down with folks, we do a risk assessment of what are they comfortable with in terms of market volatility, right? Everybody, if the market just went up 10% a year, everybody'd be fine and dandy and nobody would have a problem, right? But it doesn't work like that. Even if it averaged 10% a year over 20 years, you're going to have some ups and downs along the way. And depending on when you take those losses, that can really impact a retirement, right? Sequence of returns risk is a very large risk in retirement. It's different while you're accumulating for 30 years. When all of a sudden you start taking money out of your nest egg and you have some market losses, that can be critically damaging to your retirement hopes and dreams. So rebalancing is really, if you are comfortable and we deem it that, maybe you need a 60-40 stock versus bonds or some sort of fixed asset to create the stability in your portfolio and brings you comfort. Well, if stocks go crazy one year and all of a sudden now it's 70% of your portfolio, now you're 70-30, that's probably a little more risky than you want to be. And if the market were to take a swan song the next year, you're going to take a bigger loss than what you're comfortable with. So it's important to stay on top of that. That's something we monitor when we do an initial plan for folks. We always say, listen, this is a rifle shot in time. But we're looking at it in today's numbers. That's why it's important to get together each year and make sure that we update everything. And as I say, keep you between the rumble strips, right? Going down life's highway as we go through retirement. Rebalancing is part of that. Those are some of the the rumble strips we use to make sure that we're not taking on too much risk and putting you in jeopardy.